Okay, everybody, just to let you know that I'm actually here tonight, which you obviously are sure I am because we just spoke. I'm here. Just want to let you know that I'm real. It's not a recording, and we'll get going. So tonight we're going to talk about option trading for rookies. Anything you have as far as questions go, I'm not going to take them here tonight because I know people are stretched for time. So you can email me anytime, and I love to hear questions at cal@optiontradingforrookies.com. Anytime you have a question, any day or night, and I'll get back to you as soon as I can. So anything that doesn't make sense here tonight, please feel free to hit me up with it. I'd be happy to discuss it with you. Okay, so what is this? Well, this is an advanced strategy, earning monthly income through what we're going to talk about here, which is the short or naked put is another term they use. It's basically selling options is what we're talking about. And we're going to discuss just selling puts tonight. Just a quick refresher on who I am if you don't know. My name is Cal. I was one of the original rising stars on a website called tastytrade.com, which is where I got all my information. By my calculations, I probably spent somewhere in the neighborhood of 5,000 plus hours learning through Tasty Trade, probably the same amount or equal doing it on my own. So if you're a Malcolm Gladwell fan, I've probably put in my 10,000 hours, but I'm always learning. But I like to pass what I've learned as quickly, as concisely as possible, because I don't want you to have to spend 5,000 hours to learn this stuff. And that's why I've come up with this analogy, which I call driving the car. And if you've never heard this, what that means is this is a car. Obviously, the majority of us, if not all of us, have no idea that all this is inside a car and how it works. This is what I say is the equivalent of my 10,000 hours. But I don't need you to know all this stuff. All I want you to be able to do is drive the car. And that's what all my courses try and do. They try and take all this 10,000 hours and just make it accessible and easy to use so you can just drive the car. So you can take what I say for what it's worth. You can also do your own research and prove it to yourself, but I'm just trying to shorten the learning curve for everybody and get you trading and up and managing your money as quickly as possible. So what am I hoping you leave here with today? Well, either a way to buy stocks at under market value, a high probability way to earn a monthly income using options, the ability to pick your winning percentage on every trade, and more importantly than anything, hopefully the desire to learn more. Hopefully this kind of gets something going in you where you're like, hey, this is interesting. I'd like to learn more about this stuff, because there's obviously lots of different strategy, lots of different things you can learn, and I teach quite a few of them already, and I'll expand as time goes on. So the strategy short and puts has basically 3 steps to it: when to use it, how to use it, and what to expect, and we'll go through all these things in detail. Important to note, though, this is an advanced option strategy. So if you're totally new to options, if you haven't been trading them for a while, if you're not familiar with like basic option strategies like verticals and iron condors, this is probably not the place you want to start, but I would still encourage you to sit through this whole webinar just to know what is out there and what's possible, because I'm a firm believer in you don't know what you don't know. So if nothing else, this will show you that there's something out there, hopefully, that you should know. And every concept and term I use tonight is explained in other courses here. So if you don't understand it, because obviously I can't explain everything in 1 hour, just shoot me an email and I'll tell you where to find it in my courses as far as terms and concepts like that, where you can go to learn more about them. Quick little drink of water and we'll keep going. So if you want to learn and you're starting from scratch, I'll put these up here because each of the courses I spent 2 years making, and they kind of go this way. So if you know nothing about options, calls and puts, you want to learn everything you want to know about them, I'd start here to understand options completely. If you want to learn how to trade basic strategies because you already know calls and puts, this is like verticals, iron condors, and the 5 trading rules for basic strategies. And finally, making and managing profitable trades, which is really the key to success long term. If you've been trading for a while, or even if you haven't, this is really the long-term success of trading. Making and managing profitable trades is really the key long-term goal that you need to know. So once learned, what's the time and commitment that this is going to require? So I'm just going to show you real quickly. I'm going to go to a trading platform and just show you, as an example, if I wanted to make a trade in the morning, and don't worry about this, we're going to go over this in a second in detail, but here's all I would do. I would look for a stock I want. In this case, I'm just going to use IWM. It's a Russell ETF. And I would go down here. I'd go to about 44 days. I'd pick my winning percentage. We'll show you how to do that. Say like, hey, I want to earn about $1. I'd click right there. Sell the 132 put for around 99 cents to $1. Confirm and send. That's it. and I'd go to work. Honestly, that's how simple it is if you know what you're doing. You can do it in 15 minutes in the morning before you go to work, and you can manage it in the same amount of time. So with that being said, let's get started on what I just did real quick, but let's kind of go in detail. So in order to understand most of what I'm going to talk about tonight, I'm going to go over a couple of things I talk about in other programs I do. So starting off with what is an option. We've all heard of stocks and shares. In case you're not familiar, an option is what they call a leveraged product, which means it equals 100 shares of stock. So it's important to know that if you're going to play this game of selling naked or short options, you have to have enough money in your account to buy 100 shares of the stock you're going to be doing this in. So how does a short put work, or a naked put? Well, just like stock, it's the same basic assumption, which is we assume the stock price is going up. So let's just start with a real simple example and say the stock price of this theoretical stock is $100. How do I make money if I bought stock? Well, I think we all know the only way I make money is if the stock goes up, right? If it starts at 100 until it goes above 100, I don't make any money. Okay, so there you go. Stock profit is only when the stock price goes above $100. But now let's pull the short put into this thing and see how that changes things. And our assumption here is we're going to sell the short put for $5 credit, which, as we know, because options are leveraged, means $500. But what are we going to do? Let's say at the time we made this trade, the stock price was $100, and I sold the 90 put for $5. What does that look like? Well, here's what it looks like. First off, the number one assumption when you're selling options, puts, is as long as the stock price stays above my strike price at expiration, I keep the full amount of the credit I sold it for. So in this case, let's say this option was 30 days until expiration. If 30 days from now the stock price was above $90, I'd keep all $5 I sold it for, or keep $500. I hope right away you see that my chances of winning must be better than buying stock, right? If I bought stock, I only make money if it's here and above. But now, by selling the put, I make money anywhere from 90 and up. Now, I've capped my profits. The most I can make when I sell any option is what I sold it for. That's the most I can make. So the most I can make is $5 or $500 on this trade. But hopefully you see my chances of winning got to be way better than buying stock, because I'm starting way down here at $90. And as long as 30 days from now it stays above 90, I keep $500. But there's also an added benefit, which is what we call the cost basis or break-even price. And that, in this case, and we'll show you how we get that, is $85. And what that means is, at 90 or above, I keep all $5. But what happens if it goes below 90? Well, remember, I collected $5. So what happens is it goes for a one-for-one basis going down. Oops, this is going to be big. I'll have to erase this. Sorry. So what that means is, let's say the stock closed at $89 after 30 days. Well, I would still make $4 because it started at 90. I collected $5, so I have this $5 cushion right here. This is like a $5 cushion. And every dollar it goes down below 90, I lose $1. So at $89, if it closed there, I'd still make $4. Hopefully you realize at 88, I'd make 3. At 87, I'd make 2. All the way down to 85, which would be my break-even price, which means I don't make or lose money on this trade. It's a complete wash. Neither the buyer, nor in this case the seller of the option, myself, make any money. The break-even is 85. Nobody makes or loses money on this trade. But I have all this cushion, so this is still potential profit. All the way down to 85, I'm still making money at 85 or above. Hopefully that makes sense. So, when do we use short puts? There's two scenarios we're looking at. One is a stock we'd like to buy, and one is we're trying to create a monthly income stream. And you can see here the top two in bold are exactly the same thing. We're both assuming the stock price increases. That's our assumption every time we sell puts. Hang on, let me just mute this for everybody. Hang on. Okay, so you'll see here assignment obligated to buy. So that's important. Let's take a look at that. So what's assignment mean? Well, What assignment means is when we sell the 90 strike, and we said it's 30 days in this case, is just a hypothetical until this option expires. At expiration, if the stock price is below our strike price, so if the stock price is below 90 at expiration, we're going to be assigned 100 shares of stock for every put we sold. So that's why it's important to realize I might get stuck with stock if I play this game, and I better be able to afford it. Because at expiration, if the stock is at $89.99, I'm going to get assigned 100 shares. Now my cost basis will be 85 bucks, so I'll still be a winner if it's anywhere above 85. So as we talked about, even at, let's say, we'll just go now at 88. So let's say it closed at 88. I'm still a $3 winner on this trade, but I now own 100 shares of stock. The put is gone. I've been assigned 100 shares of stock at an $85 cost basis. The stock's at 88, so I still am a $3 winner, but I have 100 shares of stock now to deal with, which is a lot more of a capital requirement as far as margin in my account. So you got to be aware that I can afford this, because if I get stuck with stock, even if I'm a winner, I'm still stuck with, in this case, $9,000 worth of stock. So let's go and take a look at why this assignment thing is so important. Because as soon as people see, oh, geez, I'll sell this put way below the market, I can make a bunch of money, it's a no-brainer. So I'm going to go to a big stock like Priceline. In this case, at this making, the price was $18.18. And let's say I decide to sell the $17.15 put. And there's 46 days until expiration. So you see, this put is over $100 below the stock price. Seems like there's no chance the stock's going to go below $17.15, right? In 46 days, is it going to drop over 100 bucks? I don't know. But do these things happen? Absolutely they do, right? We all know about stock market crashes. Not very often, but they happen. Crazy things happen in the market. So most people, when they see this, they go, wow, I can sell the $17.15 put. I'll collect $1,100 in only 46 days. This is a no-brainer. I'll do this all day long. In 46 days, I'll collect over 1,000 bucks. This puts like over $100 below the stock price. No problem. Why not do this all day long? Well, because what happens if things do go wrong? I will be assigned 100 shares of stock if the stock price closes below $17.15 in 46 days, which means I will now own $170,000 plus worth of stock. I will get assigned stock. The reason you see it's $170,390 is because I collected $11.10 on this put as a credit. If you subtract that off $17.15, you get $1703.90. Multiply that by 100 shares of stock, and I'm stuck with $170,000 plus worth of stock. So I was looking to make 1,000 bucks in 46 days. Things went horribly wrong, and guess what? Now I'm stuck with $170,000 worth of stock. That's why assignment is so important. You have to make sure you have enough money in your account if things go wrong to be able to afford to buy 100 shares of stock. Essentially, it's your strike price. Okay, so now we've seen assignments. Let's look again at this stock you'd like to buy versus the monthly income. What's the difference? Well, stock you'd like to buy, obviously we'd like to buy something under market value. What we're going to do is we're going to sell a strike, what they call right at the money, which I'll show you. If we don't want to buy this stock, we're going to sell a strike that's further out of the money, and I'll show you that as well. So let's take a look at that. Before we get going, these are our rules. These are our rules for trading short puts. Again, I highly encourage people to do your own research if you want to. I'm, again, just showing you how to drive the car. So here's the rules for selling puts. The golden rule above all is we never, ever, ever sell a put strike above our stock price. Why? Because that's the golden rule. That's just how it is. Like I said, do your own research if you want to dig it up, but that's just how it works. That's the best way to play this game. We never sell a put strike above our stock price. And here's kind of the rules we take into account when we're trading puts. DTE means days to expiration, so we're looking for 45 days of expiration, volatility rank greater than 50. POP, or probability of profit, that's a chance of making at least $1 profit on a trade. We're going to pick our own win percentage through delta. I know this is all probably confusing. Don't worry, we're going to explain this all in a second. And finally, break even and cost break-even price and cost basis, which we've seen already. I'll go into in more detail. So I'm going to go over a couple things that I talk about in way more detail in other courses, but in order to understand this, I think it's only fair you at least understand a couple of the concepts because they are the rules. Number one, duration over direction. What does that mean? Trading rule number one is we always trade as close to 45 days as possible, never less than 30, and we prefer not more than 60. So what that means is if it's between a 29-day option or a 61-day option, we're always going to choose 61. So when I say trade as close to 45 days as possible, what does that look like? And here's just another trading platform we're taking a look at, XME stock. And here's the way it works. This is an option chain. You see September, October, December. Obviously, these are old. And right here in parentheses, you see 9 days, 37 days, 100 days. So with a rule at 45 days, what does that mean we're going to trade? We're going to trade as close to 45 days as possible, which means 37 days is the option chain we're going to use in this case. Simple rule, trade as close to 45 days as possible. Number two is volatility. We may not all be aware of what volatility is. So what is it? It just refers to how volatile a stock's price can be. So the simple takeaway is when something's highly volatile, more volatility means it's more expensive. Less volatility means it's less expensive. And all it means is how volatile a stock's price is. But this is the important part. More volatility is more expensive. Less volatility is less expensive. Which gets us to trading rule number two, which is we always prefer a volatility rank over 50 because that means it's volatile. And why is that important? Because if you're selling something, what are you looking to do? If you're selling your house, do you want to sell it for a low price or a high price? I would think you'd say a high price. Volatility rank tells us when options are expensive. So that's how we use it. We're always looking for volatility rank greater than 50. We may not always find it, but that's our goal because that tells us the options are expensive and we like to sell expensive things. And that's why volatility is so important. Now, the only two platforms that I personally use that I know have volatility rank, and I am in no way pushing either of these. These are just the two I use. I'm sure there are others out there that have it. I just don't know. So feel free to find your own platforms that do this. But for sure, Tastyworks and the Thinkorswim platform on TD Ameritrade both show volatility rank. I use both these to trade. Like I said, I'm in no way pushing them. Find whatever platform you like, but try and find one that has volatility rank. That's really going to help your trading a lot. And I know for sure these two both have it. So just to show you what high volatility and low volatility look like in reality, I think it's important to take a look at an example. So in this case, we're looking at two stocks, not even important, Yahoo and something called XME, which is an ETF. Here's the important part. Both these stocks, I know this is small, so I'll spell it out for you. Both of these stocks are right around $41. In both these stocks, we're using the same option chain of October with 37 days. And in both these stocks, we're going to look at the strikes 41 and 42. So what does high volatility look like compared to low volatility? Well, if we're looking at the exact same strikes with a similar price stock, similar option chain, look at this. These options up here are 278 to 281 for the 41 strike. Down here, they're less than half that much at 114 to 125. Whoops. The 42 is 235 to 238. Down here, it's only 68 to 75, less than a quarter as much. That's what high volatility tells you. Same price stocks, same option chain, same strike prices. Up here, if we're looking to sell one of these options, we'd obviously be looking to sell this one because look how much more money we're going to earn when we do it as opposed to this one. And that's why volatility rank and volatility is so important. It tells us when things are expensive because we're not going to look through every stock on a watch list that's all around $41 and compare the options. Volatility rank tells us right away which ones are trading at a premium. So, quick definitions. Probability of profit. I'll use POP a lot. All that means is my chance of making money on a trade. My probability of making at least $1 profit on a trade. That's POP. The shortcut to POP, which we'll look at, is delta. Again, don't worry, we'll show this on a trading platform. And break-even price is synonymous with cost basis, exact same term. And as we said, this is the exact price where the buyer of the option and the seller of the option, which is you in this case, would make no money. Neither the buyer nor the seller make any money. We all completely break even. And how do we figure out break even or cost basis? Very simple formula. All we do is take our strike price, which you saw was 90 in the example, and we subtract out the credit received, which is $5, and that gave us our $85 break even price / cost basis price. Okay, so let's go to a trading platform and look at all these rules that I've just kind of laid out in detail on a trading platform. I know, again, this is kind of small, so just bear with me. So we'll start with strike price is strike price is always below stock price. So if we see here, if the stock price is 138 and our strike always has to be below our stock price, that should tell us right away that everything from 139 down, all these strikes, 139 higher, are out of commission. We will not sell any put 139 or above because that breaks our golden rule of being above. Our put price there is above our stock price, and we never do that. So that leaves us with everything from 138 down, which is plenty of choices. So we're going to go from 138 down and start selling options. So let's look up here, 45 DTE. As you can see, here's all the option chains. Here's all the days to expiration on this platform that are in parentheses, and you can, see 4/11/18, and I chose right here the 46 days to expiration. Why? Because it's as close to 45 days to expiration as possible. Next is volatility rank greater than 50. Right here, I can't show it to you. I'll show you on the live platform where you find that on the Thinkorswim platform. Like I said, it's up to you to go find it somewhere else if you're not going to use a Tastyworks or Thinkorswim platform. So let's get to something that we know is sounding a little more confusing if you've never heard it. Inverse delta equals POP equals out of the money percentage equals pick your win percentage. Yow! That's a mouthful. What does that mean? All that means is if your platform doesn't have this column, which is probability of out of the money, this is POP. Probability out of the money is my probability of making at least $1 on this trade. You see here it says 92. So every platform should have what they call delta. And all we're going to do is, as a shortcut to finding out this number, if our platform doesn't tell us, is we're just going to take delta, and I say inverse because it's out of 100. So all we're going to do is take delta and subtract it from 100 to get our shortcut to POP, or probability of making money, or probability of winning on this trade, probability of profit. And you see it's pretty close, right? This is a shortcut. So if I subtract 7 from 100, this should be about 93. Pretty darn close. If I use 15 here, it should be about 85. It says 83. Pretty darn close for a substitution. If I look at 36, we should be looking around 64. You can see it says 62. Again, it's just a shortcut to figure out a rough idea of POP. Pretty good estimation. So all we're going to do, when I say inverse delta equals POP, all we're doing is taking delta, subtracting it from 100, and now we got our chance of making money on this trade. It's really that simple. So let's go now to higher POP equals lower income. Higher chance of making money equals a lower potential for making money. That may not make sense right away, but let's just take a look and see why it does. If I were to sell the 124 put, as an example, do you think I'd have a better chance of making money on that trade than if I sold the 138 put, which is only 58 cents below the current stock price? Of course, right? Of course. This is about $14 away. This is 50 cents away. Obviously, my chance of making money is way higher here than here. And you can see over here that it is. It's about a 93% chance of making money on the 124 put versus a roughly 50-50 shot on the 138 put. So why would I sell one over the other? Well, higher POP, lower income. Higher POP, 93% chance of making money. If I sell that, I'm only going to sell it for around, let's say, 32 cents. Lower POP, right, 50-50 bet, Now I sell this and it's almost 260. More risk, more reward. We've heard that 1,000 times. That's all it means. Higher POP, lower income. Higher POP, lower income, lower POP, right? More risk, more potential reward. That's all it means. And finally, cost basis and break-even price. Real simple. Let's just look at two examples. We'll look at this one right here, just because it's an easy number, and we'll go to 132 because it's about $1. So, what's my break-even or cost basis on the 124 put if I sell it? It's the strike price minus the credit received, roughly 30 cents, means if things go against me, oops, I'm going off the screen. If things go against me, I'm going to get stuck or assigned stock at a 123.70 cost basis. I'll have to buy $12,370 worth of stock if the stock price closes below 124 at expiration. So hopefully you see at 132, we'll go over here, 132, we're going to collect about $1. If things go horribly wrong and the stock price closes below 132 at expiration, I'm going to get stuck with 100 shares of stock at $131, which means $13,100 worth of stock is what I'm going to have to be able to absorb in my account if things go horribly wrong. And that's why cost basis break-even price is so important, because that'll tell you like how much money do I need to have in my account if things go horribly wrong. So let's just zoom in to one when I talk about buying stock at under market value or earning a monthly income. So remember, 138 was the closest put we could sell, and if we do that, we're collecting 255. Obviously a fair amount of money, right? That's a good thing. More risk, more reward, so we have a chance of making 255, and it's a roughly 50-50 bet. And at expiration, when we work out our break-even price, if the stock closes below 138, we're going to get assigned stock at 135.45. But we're willing to take that risk. We don't mind owning the stock, so we're going to sell a put right next to the stock price because we're trying to make a bunch of money. And we don't care if we get put the stock, and if we do, we're still getting it at a much lower price than it was when we started. Remember, when we made this trade, the stock price was 138.58. So even when things go against us, we're still getting put the stock over here. So we're going to hang on to this thing till the bitter end, and at expiration, if it's below our stock price, well, we're going to own $13,545 worth of stock, or if it stays above 138, or actually 135.45 will give us a piece of the profits. Anything above 138 will keep all 255. 50% monthly income. Down here, we don't want the stock, so we're going to sell a put that's further away. And you see there's an 83% chance when we sell this 130 put, because it's about $8 away, and we'll keep $71 as long as it stays above 130. And our break-even price is right there at 129.29. So you'll see it's $6 less. So if we get stuck with stock, hopefully we won't. We'll close this, but we'll get $12,929 worth of stock. That's the difference between holding on to stock and buying it under market value and selling the at the money, as they call it, put. Right? At the money is the one that's just below the stock price. If we don't want to own stock, we're trying to make income, we're selling a put further away because we're going to have a much better chance of making money. You see 83% versus the 50-50 shot. That's the difference. One, we're shooting for the fences. We're going to go for the win, try and collect as much as we can. If we don't, we'll put stock at an under market value. The other one, we're just trying to collect a monthly income with a high probability of doing that. So let's go to the live platform. We'll go through all our rules in the live platform as of today. So here we are, live platform. This is the TD Ameritrade Thinkorswim platform. I'm going to just look here at the IWM, which is an ETF for the Russell 2000. So first off, what do we look at? Volatility rank on this platform. If you go down here, today's option statistics, and you open this up, you'll see right here, current IV percentile is another term for volatility rank. In this case, it's only 15. We're looking for 50 or above. Okay, remember it's a preference, not a requirement. So in this case, not the best stock, but totally doable. Once again, if we want to shop around and try and find something better, absolutely go for it. but this is still completely in the realm because it's a preference, not a requirement. Next thing is we're going to look for the DTE, right, as close to 45 days as possible. Here's all the option chain down here, and in parentheses on this platform is all the days to expiration. Close to 45 days as possible would put us right here at 44. Perfect, right? Right in the wheelhouse. This is the option chain we're going to use. So 2 rules down right away. It's that simple. Now we're going to open the option chain, and we go to our golden rule, which is right now the stock's at 138.98. So what do we never do? We never sell a put above the stock price. So in this case, you can see 139 is above the stock price. So everything from here down, these puts are out of reach. We do not touch these, which leaves us all of these and more if we want to stretch it out more. So there we are. We've taken care of our golden rule, days to expiration, all the good stuff. Now we get into higher POP, picking our win percentage. So it just comes down to risk reward. Do we want to take a lot of risk to make a potential high reward here and sell the at-the-money option and try and collect as much as possible? And if we don't, we're going to get put the stock, but we're going to get put the stock at 138. Whoops. 138 minus the credit received. Let's just say it's 250 in this case. So if things go horribly wrong, we're going to get stuck with the stock at 135.50. But that's well below market value when we made this trade, because right here the stock's at almost 130, 139. So if we're looking to take a lot of risk and potentially buy stock at under market value, we're going to sell the 138 put. If we're looking to collect a monthly income, now it's purely a game of risk reward. What do I want my chances of winning to be? You know, how much risk am I willing to take for how much reward? In general, my wheelhouse is anywhere from the 15 delta. I can stretch it out here. We can go further if you want. Anywhere from the 15, let's just make this more so you can see it. My wheelhouse as a trader is anywhere from the 15 to 30 delta. Generally speaking, I'd say as a beginning trader, I would always just default to the 15 delta. It's essentially one standard deviation is what they call it. So roughly 85% of the time, this is going to be a winner. So if you're a new trader, this would be the wheelhouse I would be shooting for, but it's totally up to you. Are you happy with a 70-30 chance to make $1.60 rather than an 85% chance to make 75 cents? All comes down to you. Once again, right, higher POP, lower income. As the POP goes this way because you're getting farther away, the income goes down. So higher POP, lower income. Again, we look at our break-even price and cost basis. Can we afford to buy the stock? Is this a stock we can do this in? Essentially, I'm going to have to buy stock somewhere in the, if I'm down here, around $13,000 in stock is what I'd be forced to buy if things go against me. Can I afford that? Okay, I don't know. That's everybody's decision to make, but the decision is made right here. What do you want your winning percentage to be? If it's not, if you don't think 75 cents is enough, you're going to move up to the next one. I'm willing for 80-20 to collect 85 cents, etc. It really is that simple. So we're going to pick our win percentage, work out our cost basis and break even, and make a trade. And hopefully you can see when I showed you that example earlier, it really is this quick to knock it out in the morning. If you look at a few stocks you want to look at, you open up the option chain, you pick a percentage you like, and you can sell a put. Boom, the whole thing could take literally 5 minutes if you're kind of in tune with what's going on. Let me just, somebody just joins. Okay, so what to expect with short puts. Two things. We're going to talk about managing winners. This is for the people that want to earn a monthly income. With a stock purchase, we're not managing so much. We're just hanging on to the sink to the bitter end. And finally, profits and losses, assignment, covered calls, and something called rolling. So, as I always like to do, I like to default to my prime source of all my information I've learned, which is Tasty Trade. Again, that's where I put my 5,000 or 10,000 hours in total. And I'm going to use one study of theirs to show you why selling puts is good and why managing winners is so important. So, this study right here is real simple. All they did was they sold the 16 delta put closest to 45 days to expiration, which should mean to you now, if I said they sold the 16 delta put, what is my probability of profit? Hopefully you all say 84%. I just subtracted from 100, that's my POP. And they compared holding on to it until expiration, or what they call managing a winner at 50% of max profit. And what does that look like? So here's what happens. I'm going to go through this line by line because it's really important. In fact, let me take a sip before I get started on this one because it's important. Okay, so the first thing to look at is P&L, profit and loss. If I hold on to this, hold on to all these puts till expiration, you see I make 89.34. If I do a 50% managing winner, you see I make quite a bit less at 64.67. So you might say, well, why would I ever do a 50% management when I make so much more doing it this way? And that's because of down here, largest drawdown. And what that means is, on any particular trade, what's the most money I lost on any one of those 129 trades they did? And you can see here, if I hold on to expiration, because of wild moves all the way to the bitter end, I lost almost $1,000 if things went really bad. When I managed at 50%, you see, wow, I only took a $200 max loser when I did it that way. So even though the profit and loss is, let's say, 20% bigger or more on the expiration side, you can see the drawdowns are almost 5 times as much. So what they call the volatility, right? I mean, my profit and loss statement is going to have much wilder moves if I hold on to this thing to expiration because of these big losses, as opposed to just these kind of consistently hitting singles and managing these smaller losses. So yes, I make more money, but I also have bigger losses when I hold to expiration. So let's go to the next lines. Percent of winners. Again, we were expecting 84%. You see, wow, this is so much better. This is how it worked out because we've been in a bull market during this time of the study. So 94% of them were winners at expiration. But look at this. If we manage 50%, almost 100%. I mean, 98%. I know 4% doesn't look like much to everybody, but it's a huge percent when it comes down to the your trading and your profits and losses and your management over time. That 4% adds up a lot. And the way you see it add up is really right here. Average profit and loss per day. What this is telling you is if I hold on to these for 45 days, then after 45 days, I've averaged $1.55 per day in profit. That's kind of the money I earned. If you just divide out my total profit by the 45 days, I made $1.55 per day. But when I manage at 50%, obviously I'm going to be closing these trades a lot earlier than expiration. And what that means is my profit and loss, you can see, almost doubles. And that's why managing winners is so big. My profit and loss per day, my profit and loss per day is almost twice as much as it is with expiration, which means, as an example, and I don't know the exact statistics, but let's just say half these trades you manage for 50% winner. And generally speaking, when you manage a 50% winner, you're managing it about half the amount of time, which means, let's say if half these trades were winners in 22 days, I could put on the trade all over again, right? I've just closed it out after 22 days. I still got 22 days left in the expiration cycle. Obviously, I'd used a different cycle if I were to make a trade, but I could put on more trades this way. I could double up my trades on the winners, which would make this number much higher in the end because I would just be taking these off, putting them on. This is just a one-time thing. We put them on and we took them off. And it still had twice as much profit and loss per day almost as expiration. So you can only imagine if I took off my winners and then just put these trades right back on again, these numbers are all going to increase as well. So there's just a much bigger benefit from managing winners. A whole lot less volatility in our returns, much more profit and loss per day, a higher win percentage, and the chance to put on more trades as well. Just all around win, 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 win when we do something called manage winners. So I put this up here again because I really think it's that important. This is all about making and managing trades, and I think now you see why this is so important. Once you learn to trade, verticals, iron condors, naked options, this is how you make and manage them. It's obviously a bunch more rules besides managing winners at 50%, but this is one of the key things we do. Managing trades is the key to long-term success when you're talking about trading. So let's go what to expect with short puts. So we've already learned, obviously, assignment's worst case scenario. So what are our options when we're selling short puts? Well, we can always close early. We don't have to hold on to this thing till expiration. So if things go against us, for us, whatever, if we manage winners, if it's way against us at expiration, we don't have to hang on to this trade all the way through expiration. We can take our loss, close early, and walk away. Obviously, if we hang on to it, we're going to be assigned the stock at our new break-even price, in which case we're going to want to do something called a covered call. Obviously, I can't get into everything here. I have a whole course on covered calls themselves. So if you're going to get into the naked option game, you absolutely want to know what covered calls are, because when you get assigned stock, this is immediately the first thing you're going to do, is you're going to go into something called a covered call. You're going to start selling calls against your stock to keep reducing your cost basis. And finally, the other option is something called rolling. And this is going to be a whole nother production in itself. This is a fairly complicated topic, and it's much more art than science. I will make a course down the line about it. I encourage you to do some research online if you want to look into what rolling is. I can't obviously go into it here because it's a long, drawn-out procedure, but rolling is the other option you can do. So those are our expectations of short puts. Either we close early, we get assigned the stock and go into covered calls, or we do something called rolling. So once again, just a quick refresher on my courses. If you know nothing about options, these are the three you want to start with. This is that 2-year window, starting with what they are, trading basic option strategies down to making and managing. If you already know this kind of stuff, I have a whole thing on multiple option iron condor strategies. This is the covered call. And today's course is right here in much more detail. And of course, I just put out recently, talks about selling calls as well, and a bit more detail about what we talked about today. So hopefully, like I said in the beginning, you left here with understanding of a way to buy stocks at under market value, which would be that selling the at the money put. If we're looking to make more money, more risk, more reward, and we're not scared to buy the stock, we're going to sell that at the money put. If we're looking for a high probability way to earn a monthly income using options, obviously we're going to go further away, what they call out of the money options. Again, remember, higher income, lower POP. Lower POP, higher income, which is the equivalent of more risk, more reward. We've seen also how to pick our win percentage. All we're going to do is look at delta, subtract it from 100, and that's going to give us our POP, or our probability of profit, our chance of making money on a trade. And finally, hopefully, if nothing else, even if this confused you, it hopefully gave you the desire to learn more, because it really is not that complicated. I can't stress this enough. The learning curve I've tried to shorten for all of you through my courses, because as we've all seen, many of us, if not all of us, have money with somebody somewhere, 401ks, financial advisors, whatever, and all we do is watch our money go up and down. If nothing else, you should learn to manage at least a portion of your own money just to save on fees, try and learn how to do it yourself, because obviously nobody cares about your money more than you do. So if you can learn to trade your own money and manage it, it's just a nice skill to have, and you can do it for the rest of your life, and hopefully you see it does not require a lot of time once you learn it. If you have any questions about anything you've seen here tonight, please just email me, cal@optiontradingforrookies.com. I love answering questions, so don't feel scared or shy. Anything that didn't make sense, send it to me. I'll be happy to answer it. I love answering questions because this is what it's all about. I love seeing people take this on and start to learn it just like I did through Tasty Trade. Thanks again for all your time tonight. I think we're right on time. Like I said, thank you for joining me. You will be getting some coupons in the mail so you can buy my other courses at discounts if this is something that interests you. I highly recommend it. Like I said, it's something that everybody should at least know something about. Whether you do it yourself or not, you should understand how to manage money and what the market tells you and how it works as far as calls and puts. So again, thank you all for joining me so much. I hope you got a lot out of this, and I hope you continue to learn more. Talk to you soon, hopefully via email or at one of my next courses. I do this first Wednesday of every month. I do a webinar, so please feel free to join me every Wednesday, first Wednesday of every month. Thanks, and have a great summer, and happy trading.